I'm Adam Grimes, and welcome to Module 3, Unit 2 of the Art and Science of Trading. This topic is trend and range. We're going to start to refine these patterns. What we have done in the previous module is to look at the outline structure that's underneath the chart. We worked in swings, pivots up to swings. And it's important. Frankly, I think many people get here after years and years of reading a chart. They start to understand this, and I'm having you focus on this at the beginning so we can build your understanding from those core elements. However, though that structure is very important, it's maybe not something we can apply directly. And what we're going to do in this module is start moving much, much closer. We're gonna look at the actual patterns in the market. We're going to spend a lot of time looking at charts, and we're going to be moving much, much closer to structures that we can trade and really looking at the practical problems of applying this theoretical structure. So just to dovetail into where we've been, here's where we've been. So we focused a little bit on chart stories. Now, that's gone from this module forward. There still will be times when you may want to think about it, but you're not going to do specific chart story work for all the reasons we've talked about. Hopefully that's a part of your thinking. If you feel that it's not a part of your thinking, that you haven't done enough of that, go back on your own, look at some charts, force yourself to do some chart stories. It's, there's definitely value there. The bar is very important because it's the smallest unit on the chart. And of course, there are some times we can read inside the bars. We spent a lot of time in the last module going out to this swing level. I'm not going to read everything on these slides for you because this is just a very quick review. You also know this, trends and ranges, directional, non-directional. One of the two things that I do want to highlight here is that trends are comparatively easy to read. Now, I say comparatively because ranges are more difficult to read. Neither of these are actually easy. There's enough randomness, enough noise in the market that there's a lot of complexity, and even the best possible chart reader, you're going to be wrong a lot of times. It's just the nature of the beast. It's the way it works. But you will probably find the patterns of trends are a little bit easier to read than the patterns of ranges. So we also looked a lot, and you did a lot of swing analysis, analyzing whether the market is in a trend or a range. And conventional wisdom will tell you that the market is always in one or the other. But I would add a third possibility to that. I would add uncertain. And we're going to see exactly how this works here in about 30 seconds. One of the other things, just a little preview, not in this particular unit, but soon there's an entire unit that is on these transitions between trend and range, and then you're going to be looking deeply into those in your homework. And this is really, if you think about it, you have a market that's trending, and then something starts to happen. A lot of the opportunity and a lot of the challenge of trading comes at these transition points where we try to figure out what happens next. And, again, there's a limit to how good we can be with that, but those areas are worthy of quite a bit of focus. So here's kind of you did this specifically, but just a very rough outline that we have a market here that is in a range, and then it breaks into a trend and goes back into a range. And you learned how to do this with looking at the swings and with seeing where we either made a new low or did not make a new high. And that's important. But this is, of course, very stylized, and we can always find examples. Here is an example that fits the previous idea. So I have real price bars. Right now we're looking at live price data, and clearly range into a trend. We can define the trend any number of ways, and then into another range. This is nice. This is a very neat example. But what's happening here? This is a little bit more complicated. So the first thing you might think about doing, I'll erase these in a moment, but let's just kind of outline some very rough swing structure. And there's more than one way to do this, which, is something we can think about in a moment. But and then we could look at this and we could say, well, where do we have higher highs and higher lows, right? You know how to do this. Where are we in a trend? Where are we in a range? That's one way to do it, and that's a useful way to do it. We can also look at just in general. The market appears to be ranging here, and then it appears to be trending, but are we ranging here? Are we trending here? See, depending exactly how we define things, we don't really know. And look at the end of the chart. What's happening here? Have we broken in? What do you expect to happen? Are we breaking into a downtrend? Are we beginning another range? This is always a question. People will talk about, this is actually a very important concept. I think I mentioned it before, but this hard right edge. It's one thing to look back here in the middle of the chart. And, even another thing over here where we can easily say, okay, it goes higher. But when you are working and all of your actual trading, of course, will be right here, there's a lot more uncertainty. But, so look at this. What do we expect to happen next? Here is actually what happened next. This is this point. And I don't know that was exceptionally predictable. So it turns out we probably went into some kind of big range there, and then this uptrend continued. That's probably the best way to read it, though you may read a downtrend in there. A lot of different definitions. And all of this hangs together with this fundamental trend pattern. We've talked about this, the thrust, the retracement, another thrust. Same thing to the downside. Very quick hit review here of this fractal trend structure. That whenever you have a trend thrust, if you zoom down on time frames, you probably have, I'm actually not drawing these very well, but by now you know my lack of art skills, right? So we're all comfortable with that. It's all out on the table and very obvious. But this idea that nested within, and if we drill down from monthly charts all the way down to, let's say, 1 tick charts. I remember from one of the very first modules. Of course, these are going to look a little bit different. This idea of things being fractal, I don't think quite works in the way a lot of people would like us to think. In other words, you certainly could tell a difference between these extremes. But the core idea is correct, that you see this type of drive, rest, and then another drive on all time frames. We just hit on this a little bit of defining trends and ranges. And major point here, we worked with a simple but precise rule set in the previous module. Now I want you to be aware that there are going to be times that you just don't know. The definitions matter, the time frame matters, and you'll see that. Swing definition of trend, we've done this. Higher high, remember, just in case. This is so important. That's why we did it over and over and over, and now I'm reviewing it. Higher high, higher low. Even if we step away from this precise structure, it is still important. This is still conceptually important. Good uptrends both drive to new highs and hold higher lows. This is not a particularly good uptrend. This is not a trend that we would trade with confidence. Compare this to something that looks a little bit more like this, and you may have some noise or something, but this idea is valid and useful in trading. Uptrend, higher high, and of course a higher high and higher low, and a downtrend we would think, of course, critically makes the lower lows, but the retracements also will generally hold lower highs. So if conditions are not fulfilled, assume range. We've been through that. Trend ending patterns. Now, you saw some complications with this, and you're going to see a lot more. That just because a market fails to make a new high, that is not a reliable reversal signal. There are plenty of times that a market fails to make a new high and makes lows and then continues higher. And this is the kind of stuff you're going to see a lot more as we get into real data. This should look just like your homework. You were familiar with how sometimes, and you probably noticed, right? Sometimes we flip to downtrend at almost exactly, I chose this example carefully, you can see, at almost exactly the wrong place. And, depending how you define swings here, you will get very different definitions within the same chart. Here's the same chart with a different set of swings and yet another set of swings. So That's all the review we're going to do. Everything from here is fresh and new. New set of rules for you. You can be, now that you have done the work, you can be a little bit more discretionary with how you define swings. In other words, we don't have to always use this pivot-driven structure. It's a good reference, but in practice, you can many times just see it from the chart. And there may be times, like, I'm going to flip back and forth between these two charts and just watch the swings change. Which definition is correct? Well, and here's, I believe, a third possibility, right? It's not that one is correct or even more correct. It has to fit the context that you're using it. So it is possible that you and I would have completely different trend structures in certain details, but the big picture, which is really what we're looking at with this stuff, is going to be relatively consistent. One of the interesting ideas, and if you're a kind of programming type and you want to play with some things, you can use a higher power for a pivot definition. What I mean by this, so here's a pivot high. Remember, pivot high is surrounded by a lower low and, I'm sorry, I misspoke. That's totally wrong. A pivot high is preceded and followed by a lower high. I hope you knew that was wrong. So what I'm saying you could do would be, when I say power, you require two lower highs, both before and after. And of course, the problem with this is we're not going to be able to define this until we have more data on the chart. So if you're working at that hard right edge, you're not going to be able to define your pivots there. You're going to have to wait for it to move. You can look at 2 or 3. Another thing you can do, because we'll see a lot, I'm going to erase these marks in a moment, but we'll see a lot of noise. And one of the things we want to do with this is to filter out the noise. So it's a good idea to require a certain size move, which I'm jumping ahead and using words that we haven't talked about, but a volatility-adjusted measure, some kind of range-adjusted measure, perhaps even a percent, though I would favor the volatility-adjusted measure. So you're saying, okay, I'm not going to flip down until we've come a certain distance off of one of these pivot highs. Those are ideas. If you want to quantify it, I'm not at all suggesting that's necessary. It's fine to work pretty subjectively. I believe by this point, if you have worked through all of this with me, you can trust your eye. We're looking for obvious extremes. Spend a little bit of time drawing the structure on charts. There's not a lot of homework with that, but you can do that on your own, and you can now be working toward more and more intuitive readings and definitions of these swings. So when we think about trend strength, what we're doing here, and pay attention, this is important, and this is practical too. What we're doing is comparing each swing to the previous swing in both price and time. So what I mean is, actually I have some pictures in a moment. I will show you that. Let me just read this one. Swings that are longer can be assumed to be stronger. And if they're equal length, we can assume that it's pretty much the same strength. This is a simple price-based approach. And what we're saying is, if the market had enough momentum to generate an upswing like that, this is very common sense, right? If the next upswing, let's not worry about the downswing, but let's just say the next upswing looks like this, you tell me, are the people buying the market buying it with more or less conviction? It's pretty obvious, right? Conversely, if the next one is like this, well, there's a little bit more strength behind it. So that's the very simple idea. It's a price-based approach. It also will lead many indicators. There are no leading indicators, actually, but this price-based approach many times will give us insight into the market that we can't get any other way. Now, this is still only context. It's probably not possible, maybe one of you will prove me wrong on this, but it's probably not possible to trade this structure even with the understanding of trend strength on a stop and reverse basis, but perhaps it is. Remember, we're not looking for precise definitions. We don't need those. Close enough truly is close enough in this work. you first, just practical standpoint, how to do this, define swings. I'm suggesting several ways you can do it. You can use pivots, market structure like we discussed. I pulled this from another presentation. Use algorithmic tools, which we just discussed. You also can do it intuitively. Now that you have done this work with discipline, you can work toward an intuitive understanding. And then you consider each swing in context of the previous swings. So you want to compare to the actual previous swing. Let's look at this structure here. So let's label these. Let's say we're going backwards in time here. Just to be clear, we're talking about swing A. So I can compare A to B. B is the previous swing. It's a downswing, but it is the previous swing before A. So I can compare A to B. That is comparing the swing to the actual previous swing. I can also compare to the previous swing in the same direction, which is what I was suggesting on that previous slide. We would be comparing A to C. Both are valid. I do think, however, this is probably most relevant locally. What do I mean? If you're looking at a big chart, you kind of want to look at things in the same area. You probably don't want to compare. For instance, you're looking at a daily chart. The bars are daily bars. It doesn't do much good for me to compare data from 2017 to 2014. Probably. If I'm looking at an intraday chart, I'm looking at a 5-minute chart, I probably don't compare swings today to swings 3 weeks ago, right? I would compare swings today to other swings today, or if it's early in the day, maybe to the end of day yesterday. So I'm working locally on the chart to try to understand the dynamics that are happening right now. Every now and then you'll see somebody they'll do some kind of analysis where they're comparing all through the chart. There might be a place for that, but that's not really what we're suggesting that you do here. Upswings so if we are in a good uptrend, the upswings will be larger than the downswings, both in price and time. Now, price is required. Just think about it. If the market is going up, that means that these upswings are bigger than the downswings. That's the only way it works. Now, in time, here you can see how much time did the market spend in an upswing here. And then we went into a downswing here, upswing. I'm sure I'm not quite exact here, but you can see we're spending a lot more time in an upswing than a downswing. Now, that may not in the market. That time factor might not always be true. You certainly could have a trend making good progress. In fact, ultimately, sometimes you'll see this, where the actual move in the trend direction is not quite, but is almost instantaneous, and the market will spend a lot of time. That's a special kind of trend, which we don't see all that much. Typically speaking, we want to see the upswings are longer, certainly in price, ideally in time. Pay attention to when this pattern changes, and be aware when we are in a trading range and the market is in equilibrium, you are not likely to see clear patterns. So a few graphical examples of what we're looking at. So here what I'm showing you is we're comparing the current swing B to the previous swing A, and this arrow really probably should go the other way. So this is just comparing the upswings to the downswings, so the chart is okay. But this is what we were talking about. You're comparing the vertical distance of this swing to the vertical distance of this swing. So that is comparison 1. Comparison 2, we're showing here, we're comparing the upswings, and notice what's happening. This is a market that is probably losing some momentum. This is a market where, we're having some kind of rolling over top, which is appearing in a chart formation, but what's really happening under that? And see, all of these charts formations people talk about, head and shoulders, rounding top, double top, cup and handle. These are things from the classical charting lexicon that you've heard. What they really are, and I'll show you later even more clearly, they're driven by these patterns of swings. And if you understand the patterns of swings, you don't really need those patterns the chart patterns, because you already understand them. In fact, you probably understand them deeper than somebody who is just looking for a head and shoulders pattern. But do notice this. This is important. This is an important structure to see these weakening swings. Here we're comparing swings in the same direction. And then just a third point here. This is a trend ending by surprise momentum against. This actually was, if you remember, one of your trend ending patterns, right? When you had the surprise new low. Well, look at this downtrend and compare it to, downswing, not downtrend, downswing. Compare this downswing to the downswing here and the downswing here. Well, that's a little different, isn't it? And that's actually hey, that's different. I've written about that almost in a joking context, but that's a legitimate way to analyze a market. We just noticed from a very big picture perspective, hey, this downswing is different. Something has changed in the market. Okay, so now let's look at this in context of some real market data. And I probably should have chosen some better examples. But what I've done here is I just grabbed a few recent charts. I think this is a 15-minute or something, an intraday S&P chart and a recent sugar chart. I want to show you the complexities that arise when we start to do this work. So I am drawing, and probably not with complete precision here just because of the nature of drawing on the screen, but I'm drawing the swings as my eye sees them. And, please don't quibble with me, as I said, over exact attachment points because I'm not getting exactly where I want. I'm getting pretty close, actually. But let me just draw these swings, and then we will talk about them. So you may wish to draw swings a little bit differently. And I think there probably are many, many ways. I would be tempted to draw all of this as one swing. So now, what do we see? Well, over here. So look, we're clearly in an uptrend. We're holding higher highs and higher lows. And the upswing is obviously longer than both the previous swing and the previous upswing. Here, though, something happens. This is an upswing that is shorter than the previous upswings. Maybe the market is losing some momentum. It's also an upswing that is shorter than the previous downswing. That's a warning. We could also look at this as one swing. And then we still see, though, that we still have an upswing that is less than the previous two upswings. So at this point, the market is running into some trouble. And then we go into a messier sideways trend. And I will clear these in a moment, and I'll show you another way we can define this. And then look what happens. We've had a very regular structure at the beginning and then a kind of sideways structure, which is very confusing because I would argue and I thought at the time we were in a range. And then instead of this up, down, up, down, up, that's the rhythm of the swing, right? Instead of that, we now have up, down. See that? We have a little bit of a different kind of action here, which just warns us that the trend pattern may be breaking down. So that's one way to look at it. I also see in looking at this, and let me see if I can do this. So upswing, and then here, look, we go into, at this point, I would start to define a range like this. And we make a little bit of a high, but it's not much of a high. And I would still say support is down here. A little bit more of a high. So we've switched out of the trend mode, and this is kind of an upward sloping uptrend. Upward sloping range. And this is one of the patterns that can typically precede the breakout of the top of a range. But as soon as we've kind of had this grind, which is okay, but as soon as we have this up thrust, we have price rejection. And that's important. And then, so rather than calling this a breakout, it looks like our range has just expanded. And then here, maybe we're still in some type of range. Maybe we're beginning to downtrend back toward the bottom of the range. That's how I would think about this. That's one way to read this. So looking at sugar, and let me see if I can draw this a little bit more freehand. So there are a lot of different ways you can define these swings. You may want to pick up each little swing like this. This, I think, is a fine way to outline the swings. And if you do that, let's just look at what we see here. So here we have, let's look at the downswings. This is pretty much a regular pattern, right? The downswings are roughly the same as the previous downswings. This downswing actually jumps out to my eye as being a little bit longer. Maybe we're picking up some downward momentum. If I'm trading a trend, I'm starting to get suspicious because we've had a lot of thrust, but as you can see, certainly can continue going. And then look what happens here. This particular swing is where something is a little bit different. And this is a warning. This is actually probably an area where we'd like to define this into a little bit of a range. And then look what happens. Perhaps incredibly, because this has been quite a long trend, these are daily bars, we now have a downswing that is the longest of any we've had on the chart. And then we have another downswing that's a little bit shorter, indicating maybe we're losing a little bit of momentum. And then we have a downswing that's a lot shorter, and that's the point where the market rolls into range. So let me clear all that garbage and let me just show you the ranges. So here's probably some type of range. And here, maybe we want to define this, and I know we've always defined our ranges sideways. This is one way to define it. We're going to talk about pullbacks in the next unit, the next module, but you also could say that you have this type of range, just like we've looked at. And you had here that this is a range which then breaks to the downside. And yeah, we're back up in kind of flirting with the bottom of that range. But so this is some of the type of work that you're going to be doing in your homework. And we're going to talk a lot more, just so you know, about these areas and about this area. This is all of the stuff that we're going to talk about in this module. We're going to spend a lot of time on this. So just a quick look at ranges. These tend to be more random, as I said. The market is in relative balance, and I think these two things are connected, the idea of the market being random and in balance. And I do think the edges of the range deserve your attention. That's actually quite an important idea, that what's in the middle of the range is really this random meat, but when we come out to the edges of the range, things become a little bit more predictable. And just a little bit of an illustration here. We've already seen this. You'll find some trading books that will show you trading ranges that look something like that, right? And maybe they look better than that, but point is that these are very nice, clean ranges. This doesn't happen a lot. That you'll see some exact tests, but you also see some stuff above and below the range, and this is very, very common. And you will need to, as you saw in the previous examples, look at the real market, that you certainly can penetrate under the bottom of the range without breaking the range. And that's what's going on here too. That rather actually probably really should have been here, right? That just because a support or resistance level is broken does not mean that it's truly broken. And, so we don't necessarily expect as soon as it's broken that the market's then just going to continue. It's quite possible that we'll go back in and your your resistance level that was here is now here. That is a very, very common structure in the market and something we're going to talk about quite a lot. So just a real quick summary here. I spent time at the beginning of this unit reviewing these definitions of trend and range, and you now have permission, because there's so many ways you can do this, to start to use a definition that is useful to you. And as you think about this, try to work within the structure that I've given you here and try to be very consistent. So, this is a discretionary approach, so you're not going to be 100% consistent. But the more consistent you can be, the more you can work toward always seeing and processing the data in the same way, the faster you're going to learn and the faster you're going to become a trader. So that's all for this unit. I'll see you in the next unit.